Hello, and welcome to the February 4th Virtual Investor Conference, the second OTC Markets OTCQX Banks event. My name is Rachel Nussbaum with the OTC Markets Group. Before I introduce the next presentation, a few quick points. Please submit questions in the small Ask a Question box below the slide presentation. After the presentation and question and answer session, do not log out as you will automatically be transported to the F&M Bank Corp booth where you can access additional investor materials. On a final note, all of today's presentations are recorded and are available for 24/7 replay at your convenience. At this point, I am very pleased to welcome Dean Withers, President and Chief Executive Officer, Neil Hazlett, Executive Vice President and Chief Administrative Officer, and Carrie Comer, Senior Vice President and Chief Financial Officer of F&M Bank Corp. Welcome, Dean, Neil, and Carrie.
Thanks, Rachel, and thanks to OTC for inviting us to present today. As she mentioned, I'm Dean Withers, President and CEO of the bank and F&M Bank Corp. I will be giving a short overview of the bank, then I'll be turning it over to the others for more information on more of the numbers. Of course, F&M Bank Corp is a one-bank holding company for Farmers and Merchants Bank, which was chartered in 1908 here in Timberville, Virginia, and we are still headquartered in Timberville, Virginia, a little bit north of Harrisonburg. We're obviously a community bank. Even though we've been around for 100+ years, we do feel like we have changed with the times, and I think you can see based on the screen with some of the recent accolades that we have received as ranked 148th out of 200 banks in U.S. for return on equity, ranked 14th of the top 50 in U.S. loan producers in July of 2015. Recognized as top 50 U.S. bank for social media efforts by the ICBA in July of 14 and 13. And Bank Investment Consultant magazine named Infinex Financial Group, which we're part of for our investment services, as fastest growing broker-dealer in the financial institution channel. We are located in the Shenandoah Valley, which is in the western part of Virginia, along the Interstate 81 corridor. We have 11 branches and 2 loan production offices operating under the name of Farmers and Merchants Bank. As far as location, we are primarily 2 hours from about anywhere in Virginia, the major hubs. We're 2 hours from Northern Virginia, 2 hours from Richmond, 2 hours from Roanoke. So I think that gives us a good area for people to retire in and still have the ability to travel a little bit of time and get the culture, get to some of the major sports teams around in Virginia. Again, we're in the central Shenandoah Valley. Our footprint covers a good bit of the western part of Virginia. We are 4 counties: Rockingham, Shenandoah, Page, and Augusta. And we're the largest community bank headquartered in central Shenandoah Valley. And we are the only publicly traded corporation headquartered in Harrisonburg, Rockingham County, MSA. As far as our area, we have a very diverse industrial group. We have anything from poultry, manufacturing, farming, retail trade, government, education, and healthcare. And our top employers are James Madison University, Centera Medical Center, Walmart Distribution, R.R. Donnelly, Merck & Company, Augusta Health, Cargill, and McKee Foods. So again, you can see we have a pretty diverse industrial base. We also have 10 colleges and universities in our market area. So a lot of those students come here from our surrounding areas and decide to locate here for the rest of their lives. It is a tourist area. with various Civil War battlefields, caverns, and lots of skiing in Shenandoah National Park. We also, as far as unemployment, it's very low unemployment. We currently are in the 3.5 to 4.5% throughout our area, except for Page County, which is slightly higher, around 7%. I hope that gives a pretty good overview of the bank and F&M Bank Corp. With that, I'll turn it over to our CFO, Carrie Comer, for some additional information.
Good afternoon. I'm going to start with a high-level financial review, including our recent company timeline. F&M has grown steadily over the past few years with a compound annual growth rate of 6.34%. In addition, the dividend yield to shareholders is consistently over 3%. As indicated on the balance sheet, F&M has experienced controlled growth in total assets. This is part of the historic business model of higher loan-to-deposit ratios, which leads to strong revenues. The capital ratios are solid due to capital raises in 2014 and continuing to put earnings back into the bank. F&M's asset quality is steadily improving as we work toward our strategic goals. Moving on to earnings, F&M has had record earnings for the past 2 years, and the core pre-tax and pre-provision earnings are strong. This is driven by the net interest margin and maintaining an efficiency ratio of below 60%. At this time, Neil Hazlett, our Chief Administrative Officer, is going to go into a little bit more detail on the revenue growth.
Thank you. We appreciate the opportunity to present. And as Carrie said, I'm going to do a little deeper dive into what is driving the record earnings that we've experienced the last 2 years. Current slide shows a net interest margin that has continued to increase over the last several years. 3 biggest things that are driving that: we started a dealer finance indirect auto division in the fall of 2012. That has been accretive to the net interest margin. December of 2014, we redeemed approximately $10 million of subordinated debt, which reduced long-term interest expense. And we've continued to see a decline in the cost of deposits incrementally. As you dive into the loan portfolio, the staple of our loan portfolio is still 1 to 4 family residential lending, although typically that's a 3 or a 5-year adjustable rate. We do not do any on-balance sheet 15 or 30-year fixed. Roughly 83% of the entire loan portfolio is secured by real estate, whether that's in the 1 to 4 family portfolio or commercial. We also do a fair amount of rental type properties, whether it be multifamily or single family rentals. And you can see on the grid at the bottom where it lists the loan categories by the 4 years presented. The fastest growing area is the consumer and other, which reflects the growth of the installment loan indirect finance division. Next slide gives a little breakout on the dealer finance, since that is an area that has grown quickly. You can see the portfolio balance has gone from roughly $3.7 million at the end of 2012 to over $54 million by the end of 2015. We are starting to see a slowing of the growth in that portfolio, although we expect to continue to see some growth this year, but do not anticipate it being as rapid as it has been, just because it is maturing as a portion of our portfolio. You can see the gross and net income for that division has steadily increased each year. This year, for the first time, was over $1 million, and that is on a fully loaded basis where we're allocating costs to that division for backroom support, etc., that we provide to that group. Down in the bottom, you can see some average national delinquency figures, and these figures are not just for dealer finance, but for the entire anything automotive industry as far as whether it would be direct or indirect finance. And you can see there that generally we have a better experience as far as delinquencies than the market as a whole. Fourth quarter figures are not available yet. They usually lag slightly, so we haven't been able to present those yet. One of the other things that's helping to drive earnings this year is we continue to see improvement in our non-performing and adversely classified assets, which allowed us to reduce our provision for the loan losses from $2.25 million in 2014 to just $300,000 in 2015. Back in the height of the recession, we were putting on average $4 million a year into the reserves for several years. So we're now back to pre-recession levels with a $300,000 contribution to the reserves this year. But you can see the non-performing assets have declined steadily the last several years, and the adversely classified assets are down 60% as compared to the end of 2012. Of note with the non-performing assets, although there's $9 million non-performing, over $4 million of that is 3 borrowers that we consider partially performing. They have multiple loans with us, some of which are performing or quasi-performing, but just have not reached the stage that we can return them to accruing based on financial information that's available to show, the continued support of the relationship. But we do feel, very good about the long-term prospects of those borrowers. One of the hallmarks of the way we work with customers is we did not take the approach when the recession was at its worst to just kind of slash and burn and moved on. We've tried to work with our customers, and that has paid off for us in that we've been able to rehabilitate some of these credits, get them back on accrual status, and we think that's in the best interest of the customers, but also our shareholders, because it's led to less losses than if we had pulled the plug, so to speak, in 2010, 2011. Next slide gets into funding overview. The main thing that we want to highlight here is we feel like we have a very favorable deposit mix. The deposit costs for 2015, as stated earlier, continued to decline, now down to 45 basis points at year end. The fastest growing sector of our deposit base is non-interest bearing deposits. That's now represents 24% of total deposits and has grown roughly $50 million in the last 4 years from 2012 to 2015. Where we've seen shrinkage is in the CD portfolio, particularly jumbo CDs, and we're consciously making an effort to try to rebalance our portfolio so that we're less dependent on the more volatile deposits such as the jumbo CDs. With that, we go into a summary. As Dean mentioned before, we're obviously a Shenandoah Valley bank. Our growth, our core market of Rockingham County, where we are resident with our headquarters, has stabilized. We are a significant top market as far as the deposit share. We're over 40% in Rockingham County as far as total deposits. So we look to the south to get most of our growth, which has come from Augusta County. Recently, in June of last year, we opened a branch in the city of Stanton, and in December we opened a branch in the town of Craigsville, which is to the west of Stanton. These are areas that we consider underbanked, at least as it relates to community banks. Craigsville has not had a bank since a larger regional bank pulled out about 3 years ago. The city of Stanton has actually had two mergers in the last several years of longtime banks that had been headquartered in the Stanton area. So there's a void in that market for a large community bank to meet the needs of customers that may not be inclined to deal with the super regionals or the national banks. We also have regulatory approval for a branch in Fishersville that we expect to open in late 2016. Hope to break ground here in the next 60 days or so. Fishersville is kind of the growth hub of Augusta County. That's where the large Augusta Health Center is. That's one of the two larger hospitals in our footprint. Again, we still expect to see some indirect auto growth, although that's slowing due to the maturing of the portfolio. As you've seen earlier, we're highly profitable. Last year, $8.4 million of net income, which put us above a 130 as far as return on assets. We continue to grow. We say growing toward $1 billion. Our goals are not just to grow for growth's sake, but to grow smartly and produce additional revenue. And we feel like we've been successful with that. From a standpoint of the stock, we have a good dividend yield. I think last year between dividend and price appreciation, we had overall return to shareholders of about 20%. Going back to 2011 when we hit our low price point, the stock has just about doubled. And yet at this point, we're still just right around 100% of book value. So we are excited about our prospects, both for earnings, but also the potential to drive price appreciation on the stock. We appreciate the OTC allowing us to present, and also with our upgrade to the QX market, we have seen some increase in share volume, but more importantly, increase in the number of market makers that are making a market in our stock. So it's helped reduce price volatility. With that, we are ready for questions. First question we have is tangible book value per share, and that is approximately $22 and $22.21 at the end of 2015. Another question was any guidance for dividends for 2016. In third quarter, we increased our dividend to 19 cents per share per quarter, and we target a dividend payout ratio of somewhere in the 30 to 35% range. So to the extent that the earnings would allow for it, we historically increase the dividend once a year. So if the earnings continue to increase, we'll certainly look at a dividend increase at some point next year, but it is earnings dependent. Next question that I see is, what are you projecting for loan growth in 2016? What loan category do you see leading loan growth? We're projecting loan growth probably in the $25 to $30 million range. Again, we believe that a third of that potentially would come from dealer finance, and then with the balance coming for the most part from the Augusta County market, and it would be a mixture of single family, some multifamily housing, some townhouse type developments that we're involved with, but also a lot of owner-occupied or non-owner-occupied commercial type businesses. We do very little C&I that's not real estate secured. Most things we get involved with involve real estate. Next question was, how many branches will you have after the activity you announced? We currently have 11 with the one that we opened in December, and so the one that opens fall of 2016 will put us at 12 branches total. Then there's a question that says, can you speak to the level of bank M&A in your market? Nothing has been announced recently. As I mentioned, the Augusta County market, there were two banks that had been headquartered in that market that were merged in the 2012 time frame. There are, as we said, here in the Central Shenandoah Valley, we're the largest community bank. There's some additional community banks an hour or so north of us that are similar in size to us, and there are a handful of banks in the $100 to $250 million asset range, but I'm not aware of anything currently that has been announced or is imminent in our markets. At this point, there's one more question. Why is the stock at book value? Should it not be more? Honestly, the thing that's keeping it at book value in our estimation is the trading volume is relatively low, and we may be a victim of our own success in that our current shareholders do not place a lot of shares out on the market for sale, and so there are times that the shares kind of set and don't trade every day. We are, I won't say we're extremely active in a share buyback, but we have from time to time bought shares to retire, and at this point feel that at a 1 times book, if a large block of stock were to become available, we would be willing to look at it, because we believe that our return on equity, that could be the best use of our funds currently to buy back and retire shares within the market. See if we have any other questions. What are the catalysts for growth for F&M in 2016, 2017? Have somewhat touched on that, but we believe the growth that we've kind of reached relative maturity in our Rockingham County market, and so the largest growth is in Augusta County, and that's where we've recently opened 2 branches and have another one that's slated to open later this year. Next question, what is the ownership structure of F&M, insiders versus institutional? Currently we have insider ownership, board and executive officers of about 10.7%. That does include that our ESOP owns over 5% for the benefit of employees. When we did a private placement in March of 2014, we did bring in a number of institutional investors that would own roughly in aggregate 20% of the outstanding common stock. None are currently over 5%. However, we do have some preferred stock outstanding that when and it's convertible preferred, so when it would convert to common, Wellington Management Company would be above 5% at roughly 9% total ownership. None of the others are higher than 4.9% ownership. Believe that is the last question we had, so if there are no other questions, I think we are done for today. Again, we appreciate the opportunity to present, and the presentation will still be available online for the next 90 days, so feel free to download it, and should you have any questions, please reach out to myself, Dean Withers, or Kerry Comer, either by phone or email, and we'll be happy to talk with you further. Thanks for your time today.